Gold never tops with that type of pattern. When gold tops, it makes a top. I mean, it spikes, it implodes to some extent, but it can't get back up to its high again. 2011, for example, or the low in 2015. Once you made your pivotal peak or low, you didn't go back there again.
Yeah.
You made attempts, but you just couldn't do it. Well, to keep coming back to the same level repeatedly, as we've done over the last now 5 months on gold, that's not a top. That's a launch pad.
Interesting.
And the silver and gold, silver and the gold and silver miners aren't waiting. They've already started to move up out of that.
You're watching CapitalCosm. My name is Danny. It is August 4th, 2025, and my guest today is none other than Michael Oliver. Michael, thank you so much for making the time to come on the show, my friend.
Good to be back, Danny.
Yeah, let's just dive right into the nitty-gritty here, Michael. We've got a lot of stuff going on, but let's kick it off with you. I'll let you start the tempo here. What's most prominent on your radar screen right now? What should be on the radar screen for investors out there?
Everything.
Very specific.
The markets, to some extent, impact each other. Okay, you don't just look at gold and say, what's gold doing? Well, what's the stock market doing? What are bonds doing? What's dollar index doing, et cetera? So all these things are important to look at. The stock market. In January, we put out a sell recommendation on the S&P based on long-term momentum trend breakage, meaning be gone. Leave it as an investment asset. Go away. And we had a sharp drop into April. Problem was it was news related, and those are the worst kind of drops because quite often you want a drop that nobody can quite figure out why. Okay, that's the best kind. But anyway, so we had a news related, and we predicted, where you've got a circle there, in fact, on that chart, we predicted there would be a bounce point there at 4,800, well before it ever got down there. And sure enough, they bounced at 4,835. And continued to bounce and went up and made a new high, new marginal high. We're talking several percentage points above the high we saw in January, that first upper circle. Okay. Now, this process where momentum breaks something serious and long-term occurred in 2000, in January of 2000 at the dot-com top. We had a drop into February, but then in March of 2000, it went back up and made a new high. Okay. So a lot of our subscribers said, oh, boy, you were wrong. And well, it didn't go anywhere. It made a new high and just sort of squatted. Wasted the year 2000, up and down, either side of our be gone signal. Finally, in 2001, it started to fall apart. And you never crashed or anything like that. You just had a bloody decline, 50% S&P. And for the NASDAQ 100, an 82% drop, wipeout. Okay. 2007 was a similar arduous top where, when you made your high, it didn't just make a high and collapse or anything like that. It made a high, went down, made a marginal new high with a Fed rate cut, by the way. And, that circle there is about a year of twisting and turning, with action marginally above the 2000 high. So if you're a price guy and you drew a line across the 2000 high in October of 2007, you said, oh, wow, a major breakout. Okay, well, it was baloney, okay, because long-term momentum had already said no good. Okay, finally, it started to come apart. Okay, took it a while. We've got the similar type of arduous year-wide type pattern now, where we had distribution. In other words, somebody's said in 2024, the latter part of that year, and into early 2025, I want out. And therefore, you plateaued for quite a few months, had your drop into April, then came up, and you've now made a, quote, new high. Now, by the way, when you really examine, quote, the market, not just S&P or NASDAQ 100, there's quite a few sectors, quite a few symbols, including most of the Mag 7, are not making new highs. Microsoft and NVIDIA have,
right,
and Meta, but the other 7, they're not making new highs.
Yeah, more like S&P 7, right?
Yeah, it's now the Mag 3 or Mag 2. Okay, so just as the Magnificent 7 has dwindled in terms of leadership, so has the market itself when you examine certain sectors. you'll see, hey, they're not making new highs. You know, what's going on here? I hear this new high stuff. It's very limited, very narrow. Okay. What happened last week on the close was sufficient weakness on the part of the S&P and the NASDAQ and a lot of other sectors within the market to indicate to us that there's a good chance the high you just saw prior week was it. And probably you're going to start now to sink back down. See, you're rallying today up into that gap you left on Friday. But if that high basically was it and you did enough damage into the end of the week to indicate to us that this, quote, new high is in question. And once you get price action back below the price highs we saw in January, which is in the 6,100 zone, okay? Then suddenly the guys who think this price breakout was valid will say, hey, you know, how come we're back below the old high? So that's what we're looking for right now. But it's interesting to note that, you know, there's a widespread assumption that if the stock market goes down hard, gold will go down hard too, right? You know, everybody says that. Well, look at January through April on S&P, and then look at January through April on gold. Total opposites. Gold went vertical, stock market went down. And then when the stock market decided to have its recoup and come back up to and through the highs, you would think, well, gold will sell off then if it's opposite the S&P. It didn't. Instead, it went sideways.
Right.
Totally comatose, but steady. In other words, yeah, there were sellers up there, but the sellers couldn't get anything going on the downside. Why? Because the demand was underneath it. And it
so you've got the gold price here in blue, right?
Yeah.
Like you said, there's a big divergence between the two.
Yeah. And so instead of breaking down when the stock market recouped, because we argue they're opposites, gold held well. But also during that time from April to the present, while gold has gone lateral, silver's gone up 13% since its April close. And the gold miners have gone up significantly too since the April close, meaning that while gold has gone to sleep for the past 4 months, it is starting to firm again right now as we speak. It's back to 3,400. The miners in silver have risen nicely, double digits for silver, in fact. So this is what we thought would likely happen here, is that we'd enter an acceleration phase where the prior laggards within the monetary complex, silver and the gold and silver miners, would suddenly come to the forefront and leave the mama market behind. In other words, gold's going to continue to rise in our view, probably even more sharply than it has. But at this point forward, expect silver and the miners to beat gold on a percentage basis.
Yeah, so I have gold here in yellow, silver here in gray, and then the silver miners here in purple.
Since the April close, if you do the math, it's silver's up 13% today versus its April monthly close, and gold is up a couple percent versus its April monthly close. So there's been a shift there. While things seem to be getting sold into as far as gold, but not breaking down, silver and the miners moved up. Now, how come? You know, for instance, I just looked at the screen a while ago, and the big blue chip of the gold miners is, of course, Newmont. And it has, over the years, either outperformed or underperformed the mining sector. But lately, it is really zooming. Like it's up, you know, huge in the last few months. I think there's money moving out of the stock market sector being reallocated by large asset managers to get a foothold into the gold mining sector. And, you know, Newmont had an earnings report a week or so ago that demonstrated, hey, we're making good money, folks, you know. And suddenly there's great demand for Newmont. And that indicates to me, if they're buying large blue chips, it's probably large asset managers primarily, not so much your small investors. But anyway, those two pieces of the puzzle, the stock market topping out, ultimately, therefore, flushing money out of that category into the alternative. And the only alternative that's viable lately has been gold and related.
Interesting. Let's go ahead and take a look at the gold price action in and of itself without any comparisons. And it looks like we've been consolidating since April, right? We've been building up this consolidation here. And you look at the previous year, 2024. It
Yeah,
looks like we had a similar consolidation period between
yeah, yeah.
April and then finally the breakout
Yeah.
occurred in August. And we are, of course, in August now. Should we anticipate something similar happening in the next month or so? A
Yeah, I
breakout?
think between now and the year end, we're going to have an enormous up move in the monetary metals, led by
Interesting.
silver, led by the gold and silver miners. Gold strong as well, but not on the percent basis as those subsets. Uh, and I think at the same time, we're going to see the stock market finally demonstrate to people that what's been going on since late 2024 is really distribution. Yeah, we made a marginal new high now, but by a few percent, and that's very narrow. The broad market didn't do that. Look at small caps, IWM, for example, the Russell 2000 ETF. Nowhere are they close to making new highs. Look at their highs back in January. Okay, you can see that. Also, distribution in that category since 2021. I want out. Okay. Punch up another one, XLV. It's the healthcare sector. It's like, I think, 10 or 11% of the S&P, if I'm not mistaken. There was distribution in 23, 2021, 2022, 2023. Finally, in 2024, it made a new high, marginally above the 2021 to 2023 highs, and now is sinking back down. Especially if you look at it on a monthly basis, you'll see. But right now, we've penetrated back. This is monthly, going back years here, below the highs that prevailed in 2021, 2022. So that what used to be a ceiling, they broke through, but it aborted. In other words, the rocket liftoff didn't take off. It aborted back below. And I suspect you're going to start to see panic there once you go through those lows we saw in 2022. But this action really has been naught since 2022, late 2021. If you own healthcare, you don't make any money.
No.
It's a wasteland.
Yeah, and depending on when you bought it here in this little 2022 to 2023 zone, you may be underwater by now.
Yeah, you're underwater. So there's no making money here. And there's other sectors that reflect this. But anyway, the point being that we don't trust the new stock market high that was made by a narrow select group of indexes and a few sectors. And we think once it rolls over again enough to convince the price guys, momentum's already convinced it's no good. Okay. Price is the one that people look at. And when you roll over enough, like get back below those highs we saw in January, and people start scratching their heads saying, well, I thought. And suddenly some of them realize more and more that hey, something's going on here. Somebody's dumping into the stock market since late 2024, and it's not going anywhere. And meanwhile, gold has been advancing solidly since then, and et cetera, et cetera. Anyway, that's, I think, watch those two categories because the stock market does roll over more. That's going to help fuel gold even more so. And also, we know it's going to spark the central banks into doing that which they do best, which is to, further help destroy the money unit by quantifying it more and cutting interest rates as well as the president has demanded.
Well, they have hit a new all-time high in M2 money supply.
Oh, yeah. No, the money supply is back in gear again. You look at rates for one thing, but when you look at M2, there you go. Over the last 9-10 months, it's accelerated again. So something's been going on there. No, not rate cuts, but money growth. So that's the real factor that drives gold ultimately decade to decade is the ongoing decay in the money supply. In fact, if you go back 25 years arbitrarily and go to summer of 2000, 25 years ago, July close to July close, gold's up 11-fold and the S&P is up 3.3-fold. So, which one's done better versus the decay in the money unit? Okay.
Yeah.
There's no debate. In fact, the growth in the money supply is outpaced the growth in the S&P. So anyway, that's what's going on, and I think it's going to accelerate. And gold never tops with that type of pattern. When gold tops, it makes a top. I mean, it spikes, it implodes to some extent, but it can't get back up to its high again. 2011, for example, or the low in 2015 once you made your pivotal peak or low, you didn't go back there again.
Yeah.
You made attempts, but you just couldn't do it. Well, to keep coming back to the same level repeatedly, as we've done over the last now 5 months on gold, that's not a top. That's a launch pad.
Interesting.
And the silver and gold, silver and the gold and silver miners aren't waiting. They've already started to move up out of that area.
Yeah, and we've had prior consolidations very similar to what's ongoing right now. Again, last November of 2023 up until February, April of last year, as well as October of last year. And you can see, I mean, each one precipitates another leg up. Are you able to extrapolate how big the next leg up would be?
No, except it should be more dramatic. I've said this before repeatedly, and all I'm saying is not a prediction because I think you'd go much higher than this. But if you go back and look on a logarithmic scale chart to when gold was legalized by our government in 1975, there have been 2 massive bull markets that were 8-fold gains, bear low to bull high. Well, if we had an 8-fold gain, our bear low was $1,050. That means $8,400 to have an 8-fold move. And all you're doing then is replicating what you've already done twice in the last 50 years under conditions that aren't nearly as dramatic as the conditions that are building now in global markets and in the implosion of the U.S. bubble market, stock market. Once that starts to get unfold more clearly to the average investor, that's when gold goes berserk. It's been behaving as a great alternative to the stock market already, going back a year, 3 years, 5 years, 10 years, and certainly 25 years. And yet that's not a headline story on Fox Business News or CNBC. Instead, they're focused on what's NVIDIA doing, et cetera. So that's the big game.
I see. So let's go ahead and take a look at silver. We spent a pretty good amount of time on gold. I want to take a look at silver here really quick. And I mean, silver's at 37. It's been knocking at the door of $40. And it does appear to be in mid-trend. I mean, it's still, you zoom out enough. It does appear to be mid-trend.
There's really no resistance on silver at this point going forward, other than what I call the idiot highs that occurred at 50 back in 1980 and 50 again in 2011, early 2011. But those highs, remember, decades ago. And if you factor in the decay in the money unit, which is to say it increases in supply about 90% every decade. Okay. So it's the real buying power. If you took silver to a price level that matched those highs in terms of real dollar value, silver would probably be $200. Okay. Now I'm not predicting a high. I did have predicted, however, that in this thrust that we're in now, that commenced in June, actually, when it came up to 34 again, and then finally blew through the price highs at 35. There were 2 highs there, October last year and March of this year. And then you got up to 39, and right now we're 37.5 zone. This move should take you probably to over 50. I'm guessing between 60 and 70, not just a wild guess, by the way, between now and year end. In other words, take out those old idiot highs that everybody seems to think are meaningful. Buy enough to where everybody says, well, golly, we're in never land here. Where are we going? And suddenly you wake up the population, the investor population, to a market that's already been doing quite well for the last, decade plus. And if you look at a monthly close only chart of silver net price, just the monthly closes, forgetting, and go back to 1980, for example, if you can go back that far. The highest monthly close back then was $34.50. It traded up to 50, but that was phantom. The highest monthly close was $34.50. Yeah, you see it there.
Yep.
And just short of 50 back in the 2011 peak. So those highs were really phantom. In other words, you didn't even stay up there very long. It was gaseous. And so when you made the high, you collapsed. You didn't fool around. The next month after the new high, wham, they got hit. Those highs are coming out. And I don't think we'll pause until we're credibly beyond those. And I suspect that'll be by the end of this year. And that's just this thrust. I'm not talking about the end of the bull market. In fact, my view of the end of the bull market is there won't be an end as such. I think what's going to happen is the fundamentals in play and the macro technicals, in fact, argue that this bull trend in monetary metals is likely going to end up with them becoming institutionalized. In other words, this government, that government, finally more and more saying, hey, you know, this fiat currency game, unbacked currency game hasn't really been working. It's ultimately been a negative. It creates boom bust cycles. Let's just go back to, you know, gold or silver as monetary metal. And I think at some price level, I don't know, gold may be 10,000, 20,000, I have no idea, but some level, when enough of these dynamics come into play, and I don't mean the gold price dynamics, but I'm talking about world economic situation, turmoil, a sense of uncertainty on the part of public, a sense of panic on the part of the public. And it doesn't take much to get you there, and inflict pain on the public, in other words, to where they say, we need something different. And I think we're going to have monetary metals institutionalized once again after this next crisis, which is yet to unfold in the eyes of most people.
Looking to invest in silver or create something unique? Go to firstmint.com and use the promo code CAPC. First Mint offers premium 0.999 plus silver bars and coins, perfect for stacking or gifting. Plus, they specialize in custom minting for businesses and events. Great for celebrating milestones or promoting your brand. For quality silver and trusted service, visit firstmint.com and use promo code CAPC and make your mark today. Once again, that's firstmint.com. Promo code CAPC. While you're there, check out this great deal ongoing now. Could it be a way to undo a lot of the global debt as well, if you're going to revalue gold and silver to a much higher amount? Yeah,
that's a crisis that was not front and center in the 2008-2009 drop, for example, or the 2000-2002 drop. Now it's front and center because government debt is a crisis level, and you'll notice that right now we're getting a nice rally in T-bonds, but it's still in the lower quadrant of the past 3-year price range, or the upper quadrant of the last 3 years yield range. I'm talking long-term debt, 30-year bonds, for example. So it's not acting as an alternative to the stock market, which was the case in 2000 to 2002. If you owned gold or T-bonds, you did well. Or 2007 to 9. If you own T-bonds or gold, you did well. They went up nicely in percent gain. Yeah, there were some wiggles in there, sharp ones, but they went up while the stock market went down. Right now, the only thing going up versus the stock market is the gold market. T-bonds have not really engaged. They might. But as Jamie Dimon and others have pointed out, fundamentally, this crisis, the government debt crisis, is, this time is probably not avoidable. This time it'll become front and center. And so we're questionable about whether the current rally in T-bonds, the drop in yields we've seen over the last several days, for example, is sustainable. There are some levels below the T-bond market in price that if you go down there again, you're going to get a mini panic in the bonds. Right now, you're avoiding that. But they're really not an investment alternative, as they used to be, to the stock market. So those asset managers out there who are getting a little bit antsy about the stock market because it's up, down, but confusing, they're not moving money into the bond market because it's questionable.
Mm-hmm.
Whereas the money's going into gold and Newmont lately.
Newmont, yeah, I was about to say.
It's gone vertical. And, we know who buys that. It's not the average little investor. It's a big blue chip asset manager who's not going to buy junior miners, So anyway, that's the game that's going on. I think it's about to get real noisy.
About to, in terms of weeks, months?
Over the next several months, yeah. I think starting now. I think you get gold, for example. Now, remember, silver and miners have already taken out those highs of the last, since April. Okay. But you get gold back up to 34.50, 3,500 again, back to the highs, the price guys are going to give up. And every single time you showed those plateaued regions, the last several years where it goes up plateaus, you hear this hue and cry out there. Oh, it's topping. Oh, it's got to correct back to the last high. Like right now, we got to go to 2,800, or we got to drop back to 3,000. And they've had 4.5 months to do that, and yet they can't do it. So why don't they just shut up? Okay, don't they realize that something's going on here? It's not a normal. You got to correct back to the last high story. So no doubt, if you're listening to that stuff, you've gotten out 5 times in the last year of your gold position. And at some point, you had to get back in, either at a higher level, or if you're lucky, at the same level. But it's not happening. Gold is not topping. And when you get back up probably another $50 above where you are now, that's when people are going to realize, golly, it's not going to correct. It's going for more. And they, another flow of capital will come in. This time, I think it'll be far more accelerated.
So, Michael, we've been looking at this chart here. I'm going to pull it up. Okay, so this is the copper chart. We saw a big rally up in copper at the news of copper tariffs being put into place. At one point, copper reached close to, if not, $6. And over the course of the last week or so, we've got a massive crash in copper from $6 down to as low as, I don't know, I want to say 445, 430, something like that.
Yeah.
What is that telling us? Is that signaling?
It doesn't tell me anything. It tells me that when you buy a market, first off, it's a global. I made comments in the weekend report about this situation. Copper is in a bull trend. If you go back further and you're showing there, you'll see it's in a price bull trend. That's obvious. Momentum already said a long time ago, you're in a bull trend. Okay. The 2011 highs have been nipped out a year or so ago, pulled back, taken out again. But then recently we had this newsy tariff-related stuff, just like it's impacting the stock market. First off, there's far bigger fundamentals in play out there than this come and go tariff news. Okay. Yeah, it could be a factor in play that might hurt certain industries in the U.S. market, but we've already got a stock market bubble that's going to break anyway. And regardless of what the new news might be, it's going to top out and break because of errors compounded over 15 years. Well, the same is true with commodities. They've been advancing for years here, especially look at copper. Platinum's recently joined in, and I think the Bloomberg's about to join in. But the point being that these moves in copper, it's a global core commodity. If one country, even the U.S., puts tariffs on it or doesn't put tariffs on it, that's really not going to change the global supply-demand situation. It might change our pricing a bit, but it's not going to suddenly cut into global demand or cut into global supply. It's going to cause some speculators to have bought and now to have to dump. But that's because they chase news. Forget that kind of news. Instead, look at the broader picture. This recent upturn in copper is not something new. It got well over 5 months ago. In fact, it got up to 5 a couple years ago. So getting up here was not a function of tariffs or not tariffs. So to confuse current action with that. Now, I will say this, on annual momentum of copper, which is in a positive trend, regardless of what the trend lines you want to plot on price chart, which you've got one there that was broken at one point and then it got back above it. But annual momentum says unless you get back under $4 on copper and close a month out credibly back below 4, this uptrend in copper is ongoing. And all this is a drop within the context of the uptrend. And so as you get down in the lower 4s, like 430, 440, you're probably nearing support. And it wouldn't surprise me that it just shrugs off this negative news and starts to inch its way back up again. You can see a headline event there, one day. Okay.
Right.
It's ridiculous. Yeah. Markets don't fundamentally change like that, especially based on a variable that really doesn't change global supply demand. So put that in context. And the other lesson from this is don't chase headline news. just like selling the stock market in April. And we got bearish in January before the tariff news ever got to front and forth center. It wasn't really until you got into late March before the tariff news started to hit. Well, if you finally sold the S&P instead of in January, the first week of January when we said get out, if instead you sold in late March, you got killed. Yeah, you made some money for a few weeks, but ultimately the news flipped. Trump put on his 90-day delay, all these things. And you got killed selling news because the news went the other way. Best thing to do, ignore the news. Focus on the macro trends and assume that headlines like that, which will come and go, are simply come and go things. They don't really change the major trend. And so fortunately, the stock market has shrugged that trade news off, tariff news, made a marginal new high and said, okay, I don't care about that anymore. Everything's good. So let's assume that all the tariff stuff sort of settles down now. That would be an optimal time where you can't really pin it to tariffs anymore. They're known, let's say, at a certain level. And the market then goes down without a headline. That's the way bear trends begin. Later on, you're going to get headlines, and highly likely they're going to be financial market related, commercial real estate related, little to do with tariffs, okay? Having to do mainly with the level of interest rates that have prevailed for 3 years on the long end, choking many companies that nobody's looking at, commercial real estate, for example. If you'll punch up an RWR chart, you'll see what I mean. This is large commercial. This is not mortgage stuff. These are shopping centers, companies that build computer complexes for industry, corporate type buildings. Okay. RWR, go back a couple of years, look back to 2021. You made your high in 2022. Okay. Look at that. Okay. That's when the S&P made a high at 4,800 and then went and made new highs. Look what happened to commercial real estate. It dropped just like the S&P into 2022, 23, then came back up with the S&P to the late 25 level, early 2025, and didn't make a new high. Instead, it's where it was in 2019. So you could go back even further. There's a decade of nothing here.
Yep. With
a false breakout to a new high in 2022 that it can't seem to regain.
Yeah. So this chart looks all the way back to 2009. You've got the S&P here in orange.
Yeah.
And then you've got the candlesticks here. These are
RWR.
This is RWR. And yeah, I mean, there was a big deviation between the two in around 2016.
It's too big of a sector. It's too important because these are borrowers, and a lot of their debt, I understand, long-term dated debt, is coming due this year and next year. We've already had a major shopping center. I think the largest shopping center complex in the country went defaulted on a massive amount of debt about 3 or 4 months ago. Not a headline, but it occurred, and it's in the background. It's something people aren't paying attention to. And you need to pay attention to punch up XLV. Did we already look at that, XLV?
We did.
Okay, yeah. There's another example of a major sector that's just not with the S&P. So the market is narrowing chunk by chunk. And yet the S&P, due to a handful of stocks in its top 10 holdings, same is true with NASDAQ.
It was fairly correlated with the S&P, though, all the way up until 2024. That's when the S&P.
Yeah, and then you've slumped back into the ink of the past 5 years. So, what's going on? And it's not just United Healthcare, by the way, which is being imploded. There's other key stocks in that sector. So, and this is true with other sectors as well, like small caps look the same way. So the leadership of the market is gone. We're now down to literally a handful: Microsoft and NVIDIA, okay, and now Meta, okay. Facebook is now our leader, okay. What a world. Anyway, so you're now literally down to several heavily weighted stocks in the front end of the S&P and the NASDAQ, while the rest of the market is sort of quietly tailing off in a different universe. That's not going to persist. So anyway, And once that becomes obvious what's going on, the money will flow even more dramatically elsewhere.
I see.
Yeah.
I see. Well, it's been a fascinating discussion as always here, Michael. Anything else you want to talk about before you wrap up here?
No, another factor is the dollar, but it's really not that important to gold, by the way. If you go back 10 years, the dollar right now is trading where it was in December of 2015. It's been above it and below it. Well, gold has tripled since December of 2015. Okay. And the dollar index right now is trading, if you drew a line horizontal back to the close of 2015, it's the 98 level. And where you trading at 98 on the dollar index.
Right.
So anyway, it's absurd. So, but the dollar index has, right now, you've got a price trend line there that's being challenged. But annual momentum has blown that structure. Prices usually lag to momentum. So the buying you've seen lately in the dollar is price chartists buying a simplistic uptrend. The problem is when you run 3-year average momentum and 10-year average momentum, any uptrend you could plot going back more than a decade, totally broken. So the dollar index, as far as we're concerned, is now a negative major global factor. For several years there, it was neutral. It was up and down on an 8% range, 2023 and 24. It was going nowhere. So it didn't influence anything. But now it's started to break. And probably once you go down and make yet a new low and break this price chart, then the price chart folks are going to realize, oh, golly, the dollar's in play to the downside. All the rallies were futile. Momentum says expect that. And so suddenly you've got another major asset factor that's banging into other assets, causing asset class flow out of certain areas into others. You know, if you're a foreign investor in the U.S. stock market, you care about what happens to the dollar because you own stocks in dollars. Okay, so if the dollar breaks 10%, you know, that adds to any breakage the S&P might have for you, you know, European or whatever. Anyway, that's another asset to watch.
Michael, if you were to, bet a dollar, and if you had to call out the next potential black swan being something that's completely out of left field, no one's talking about it. If you had to throw a black swan out there that no one's talking about, what would it be?
Two things. One would be the commercial real estate area that we talked about. Fundamentally, we know they're in trouble. They're choking on debt. And as long as rates don't collapse big time, I'm talking a long end. I don't care about what the short end the Fed does. The long end rates, they're in a zone that is choking. Okay. That will ultimately, the stranglehold will get too tight for this company, then that company, and suddenly you'll hear about it because it'll impact the bank. Okay. The other area that we're watching very closely is Bitcoin.
Oh, okay.
Okay. Bitcoin, 10 years ago, it didn't matter what it did in terms of the stock market. But if you overlay a Bitcoin monthly price chart on top of a NASDAQ 100 price chart, it go back, 3 or 4 or 5 years, you'll see, especially since 2022, they are overlays of each other, almost month by month. You get a high in Bitcoin that prevailed in late 24, 25, and you had a drop, and then you came back up and made a new high just like NASDAQ did. And you made the new high. Yeah, this is what? This is Bitcoin? Okay.
Yeah, Bitcoin is in the candlesticks, and then you got the NASDAQ here and whatever this is, orange.
Yeah, anyway, they've been going up together almost month by month. And you'll see, just since 2023, we got bullish on Bitcoin back in 2023, coming up off that low that you see there. Yeah, back in the 20,000s, we got bullish there based on long-term momentum. About a year ago, we got skeptical and said, okay, there's pending negative structure. We don't want to be part of this market anymore. Well, since then, it had a distribution high late last year. You'll see there's 2-3 months there. It's the same time the stock market was peaking out at around the 110 level. There were guys that said, I want out, I want out, I want out. Okay. And it sold off. And then you came back just like NASDAQ did. What's this, weekly?
Daily.
Oh, daily. Okay. You came back and punched out a new high just like NASDAQ. Okay.
When is this? When was this?
Well, see the highs in late 24, early 25. They're at 110,000.
Okay.
No, over to your right. Those highs. Yeah, this is 110,000. It's a distribution zone. You came back up to it and marginally exceeded it, but still had sellers there. Said, hey, I want out of this thing. So 110,000, give or take, has been a point since late 2024 where somebody said, get me out of this beast. And they got out and they got out. And finally, you punched through it fairly dramatically, 2 months ago. Same time as NASDAQ punched out above its highs. And then suddenly you started to roll over again. Already, if you get, NASDAQ has already done enough damage on our monthly momentum to argue probably you just saw the high. The question is, when do you go down enough to really start to cause concern? Again, look at the NASDAQ 100 when you watch this piece because they're moving together. So we're getting an up day in Bitcoin today, getting an up day in NASDAQ, right? Okay. After a recent sharp drop. You drop Bitcoin back below 110,000 by much, that horizontal line you've got there.
Mm-hmm.
Then suddenly there's going to be some price guys who say, well, I thought that was a breakout. How come it isn't holding above the breakout point? You get back below 110,000, the price guys are going to start to get a bit antsy, and they should. The rest of this quarter, which means over the next, 7 weeks or so, you get down into the lower 90,000s, 92,000, which is sort of in the middle of nowhere there. If you look at the price, go to 92,000. That's really not breaking anything when you look back at the April low of last year, which got into 76,000. But I'm going to blow a structure that's so big on quarterly momentum that you have the potential to crash, where you implode Bitcoin. Now, I've got some other metrics that argue you get down much under 100,000. In other words, not only abort back below the 110, but you drop back down toward 100,000. There's some momentum factors that say you could start to implode then. And the structure, the problem is you don't see it on a price chart. In fact, if you drew a trend line from 23 through that late 24 low, that trend line comes through, way below the market now. It's not, draw an uptrend line. You'll see you got to collapse way down to, 80,000 or something to even break it. Momentum says you don't want to get back to 100 and certainly not into the mid to lower 90,000s. Because if you do, you have crash potential. When you look at a quarterly momentum chart of Bitcoin, not the price chart, you don't have that. It's proprietary. It's in our reports. You have the exact same structure pending below Bitcoin that 1987 stock market S&P chart had pending below it. So that when you made a high in September of 87 and started the rollover, in early October of that year, price dropped enough where it didn't mean much on price, but it blew the quarterly momentum structure and we crashed 30-something% 2 weeks. I see the same structure waiting on Bitcoin, and nobody is paying attention to Bitcoin as being a serious issue. The difference between Bitcoin now and let's say 10 years ago is it's become institutionalized. So many companies are now involved in crypto, have money committed to it, some of their cash savings. BlackRock has a huge ETF commitment to that phenomenon. So many large companies are now deep into Bitcoin. And therefore, what happens to Bitcoin, especially if it's an ambush type situation, where suddenly you go from an erosion to a collapse, that's when you get what you called headlines on the sideline. They all of a sudden upset factors. Where did that come from? All we're warning right now is don't get back below the 110. That starts to light the fuse. You get back into the 90s, you get your seatbelt on. Because if you break the quarterly momentum structure that we define in our reports, and it adjusts up every quarter, you could implode Bitcoin down in the 50,000s or something and do it quickly. That would cause such disruption in certain financial areas that have nothing to do with NVIDIA, okay? Or Meta. but suddenly attention shifts to something that was not expected. So this is one of those arenas that we're looking at in that regard.
Amazing. So yeah, Bitcoin could be the big black swan, the collapse of
Could be a
Bitcoin.
black swan that is.
It's on no one's radar screen.
Well, and it's important now because it is so deeply connected in financial ways to major companies, whereas it wasn't the case 5-10 years ago. You know, if Bitcoin collapsed, then who cared? Now you have to care.
Interesting. Well, fascinating discussion here, Michael. For people who want to hear more of your work, where can they find you?
OliverMSA.com.
Excellent. We will have the link down below, so check it out, guys. If you got value out of this show, remember to give us a like and comment. Go, Michael, go in the comment section. If you disagreed with anything, that's fine too. But let me know what you disagreed on, why you disagreed, and because I do, in fact, read the comments. So drop me your thoughts down below. Subscribe to the channel so you don't miss an episode. Liking, subscribing, commenting, all of it goes a long way in helping support the channel and getting this video and this message as well as this channel boosted in the algorithm. So a little bit certainly does go a long way. And then finally, check us out on Substack, CapitalCosm.substack.com. And with all that said, I will catch you later.